I'm very pleased to be joined today by Ben Rudd, who's the Chief Investments Officer at Prudential Hong Kong. Very pleased to be speaking to you today, Ben.
Very good to see you too.
So Ben, as an investments leader in Asia, can you tell us how the recent crisis has led you to adapt your investment strategy?
Yeah, well, I'm not sure we really specifically adapted our strategy, but I think what it really emphasized is how important a very sort of structured process in terms of risk management has been. We've invested a lot of time, money, and effort in ensuring that we've got a very systematic way in terms of measuring the risks in our portfolios. And in particular, one of the key things that we've always done are doing stress tests and scenarios in terms of our portfolios to really ensure that when different things are happening, how does that impact the portfolio? And to certainly it allows us to stress test our reaction to that, because one of the most dangerous things that you can do is sort of act in a knee-jerk reaction before you have all of the facts, and end up compounding problems you have in terms of your portfolios. So I'm not so, as I said, I don't think it really changes what we've done, but it really has emphasized the importance of having those processes, because by having that, it allows us to actually avoid some pitfalls in terms of having sort of that knee-jerk reaction and actually ending ourselves up in a worse situation, given everything which has gone on in the world, which has really been quite dramatic over the last sort of 6 to 9 months.
Interest rates, low interest rates specifically. How do you deal with that kind of environment as a business?
Yeah, well, you're absolutely right. I mean, the collapse in terms of interest rates globally has been quite phenomenal in a bad way from an awful lot of people's perspective. The way we deal with that is one, I think, through the use increasing in terms of derivatives. We've always used derivatives, and we've really been ramping up our use of them because it does allow us to manage interest rate risk in a much, shall we say, more dynamic way, and also a more cost-effective way as well. The second thing is that what we have done is look for pockets of dislocation which have taken place in this crisis. There have been particular parts of the fixed income markets which, primarily due to liquidity disappearing back in the dire days of March and April, offered very good opportunities to pick up yield without taking on significant additional cost. And we've been nimble enough to take advantage of that. The final thing I think, which is very important for all asset owners, is just making sure that the processes and the costs within your portfolios are minimized. When interest rates were 10%, I remember those days, it didn't matter if the cost of doing transactions or running custody platforms, paying fees was 30 or 40 or 50 basis points, because it didn't really matter. But when the 10-year yield is at 60 or 70 basis points, as it is right now, and you're bleeding 20 basis points because of unnecessary costs, that is very significant. And I think that's crucial. All asset owners really need to go through all of their processes, all of the ways that they're investing, but also managing the assets and making sure they are as efficient as possible.
Investing in Asia in 2021, what do you think is next, and even beyond that?
Well, I think what we will be seeing in this region is a continual mature markets being a lot more mature in a lot of areas. I think there's several key areas here which are going to be crucial. One is going to be in terms of sort of more of the private credit markets. Again, with interest rates being so low, that there's increasing stress coming through in terms of banking sectors, not in terms of bankruptcies, but in terms of their ability to actually continue to provide credit. That does provide an awful lot of opportunities for private credit lenders to step in, exactly as they've done in Europe over the last couple of years, partly through changes in regulations, but also lower interest rates as well. I think the second big area is going to be the opening up of the mainland Chinese credit markets as an asset class. Obviously, we're now seeing inclusion in terms of the major global benchmarks. This is huge. The Chinese fixed income market is still one of the few very large markets where you can get real diversification benefits and also yield pickup right now as well. So I think what you will be seeing is globally an awful lot of asset owners looking towards that market, trying to understand it, and slowly but surely effectively being forced into that market, which I think will be very good for that market in particular, in terms of getting outside liquidity and outside knowledge coming in, but also I think can offer real opportunities in terms of diversification and alpha for external investors as well.
Well, Ben, thank you very much for sharing your insights on Asia today, and look forward to the rest of the conference, and I hope you do too. So thank you very much, Ben.
Fantastic. Always a pleasure. Cheers.
Thank you.